Good morning, everyone, and welcome to our class that commences consolidated financial statements. Today being the first time we are approaching this, I would want to take my time and build the foundation to the preparation of consolidated financial statements. So these days, you'll be hearing the concept of group, right? Now, the concept of group is just companies that have come together. So you have a single entity, single entities joining together as a group of companies. So that is where it's coming from. So when they come together, it means that they need to prepare one financial statement. All right, so that is how the group account operates. Now, like I said, you are just bringing together two or more companies, but that two or more companies are controlled as a single economic entity. All right, so there is people at the top making decisions towards every angle. All right, so that is what we mean. So in this case, it means that you need to combine all these single entities financial statements together. All right, so that is what we are trying to look at. And bear in mind that this aspect of your course is 25 marks in your exams, and you cannot afford to let it go. So I'm going to take my time, build a foundation, and we'll be looking at preparation of consolidated statement of financial position. We'll be looking at preparation of consolidated statement of profit or loss and other comprehensive income, and so on. At this level, these are the two main accounts that are needed. All right. So let me build a foundation for you to get it. Then you move on towards solving the problem. I'm going to be so direct. All right. I'm going to be very, very direct because it is towards your exams, but I'll try as much as possible for you to understand it as well. All right. So that is how it's going to be. This part of your course alone is controlled by so many standards, and that is what makes it interesting. So we have the standards embodying this. We have the IFRS 3, which is for the updated one, which is for the business combination, because we are going to combine businesses. Okay. And we also have the IFRS 10, which is consolidated financial statements. All right, then we have the IFRS 13, which you know already, fair value measurement. Then we have IAS 28, and that one is investments in associates and joint venture. Then you may add IAS 27 for separate financial statements. So these are the standards that we have. Now, most importantly, there are definitions we need to look at, and I'm going to limit myself to about 4 of them, all right? That builds up the foundation to this. So we are talking about companies coming together. But there are keywords like you've already heard associate. There are keywords like subsidiary, all right? Subsidiary. Okay, but they are all coming from these two points of view. Number one, there is a concept of a parent and the subsidiary and associate, which is stemming from these two basic concepts. We have control and significant influence. And I'm going to use the concept of marriage to explain this further. All right, to explain this further. Now, let's look at this concept. All right. When we talk about control, in terms of a business, all right, but before, let me even use the marriage as an example. You see a nice lady and you want to go in and probably marry them. What is going to happen is that you are going to see the lady, date the lady, trying to get some information to see if you people can go on the journey. Then later on, you actually go to see the family and do the needful to marry, all right? And what happens is that there is a dating period and there is a marriage period, okay? So in your dating period, you really don't have any control of the lady. As in, probably the lady staying with you and sleeping there with you, waking up there with you. You don't have that. So even though you are dating the lady, even though you are showing love, sometimes you may invest time and resources. Even though you are doing that, you don't have control over them. All right. What you actually have is what we call significant influence. So, in that period of the relationship, you see that you have influence. When you say something and she adheres to, it doesn't mean that you control her, because you don't control. You just have significant influence upon her life, and that you have the power to participate in her life's operations. So that is what it is about, okay? But at some point where you go to see the parents, do some payments and take the lady from the parents, you see that now you can actually stay with the lady and so on and so forth. At that point, there is control. If your marriage is based on biblical principles, then you know that you, the guy, is supposed to love the woman is supposed to submit, all right? So, and that word submit is where the control comes from. Because submission is not when you agree to do, it's when you actually disagree about something, but you humble yourself. That is what the word submission means. And that is where the control is seen from there. All right. So you could see that what we are talking about is significant influence. You have the power, all right, to participate if it is an entity in the financial and the operation decisions, all right? So what we are saying is the power to participate. All right, and we are talking about the financial and operational decisions. So that is what we are trying to talk about, all right? Then we come to control, okay? Here, it means that whoever has invested into the money, the entity, has rights all right, to variable income. They have rights and they make decisions that affect the running of the business. Okay, so that is where control is stemming from. So you actually want, so here you have kind of ownership. You have the ownership. You dictate the pace, all right? Even though here you may have some representations of ownership, here we are saying that you actually own it. Okay, here you may have representations of ownership. I mean, a lady can marry anybody, even though you are dating her. So that is how it is. So you have some kind of involvement in there, but the decision you make towards her, she is not binded to. All right. But in terms of control, I mean, you make significant decisions, all right, and it dictates the pace, it dictates the direction. All right. So that is how it is. Okay. That is how control is. Now, in terms of our consolidation, if anybody has control, we are looking at more than 50% of the voting share. And don't forget, a share is a unit of equity ownership, all right, in an entity, which means that if every share is supposed to have a vote and somebody has more than 50%, it means that the person will vote more than 50 times. So if he has 51, he will vote more than 51 times. Now, it can be 10 billion people owning the 49%. But when that person speaks, I mean, majority, he wins everything. So at this point, he makes the decisions. Okay. All right. So that is that. Significant influence, therefore, means that you have less than 50%. All right. But it is always limited to at least 20%, but not more than 50%. Okay. So that is what we mean. That is what we okay. That is what we mean. Or is you can have 20% to 50%. All right, 20% to 50%. Okay, so that is that. Now, in terms of having more than 50% in someone's entity, because you have more than 50%, that entity that in which you have more than that 50% becomes what we call a subsidiary. And here, significant influence, that is what we call associate. That is what we call associate. So that is how these principles work. All right, that is how the principles work. All right. Now, so if somebody has gone to acquire a company and is owning more than 50% or up to 50%, which is associate, we are talking about subsidiaries, what is going to happen is that they now need to combine. So whoever bought or controls one or more subsidiaries is what we call the parent company, right? So the parent company. So who bought the investment, the significant influence, the control is the person that we call parent. All right. Therefore, then the group becomes the parent plus the subsidiaries. All right. The parent plus the subsidiary. So these are the basic. Now, what we are trying to say is that once you acquire, the standard calls on you to combine your financial statement. Combine your financial statement. All right. However, there are exceptions to these combinations where the parents need not to prepare a consolidated financial. Okay, and the conditions that befall this are one. So we are talking about exceptions, exemptions of group account preparation. All right, and this is where IFRS 10 comes. Okay. Number one is when the parent itself the parent that has bought it to someone is wholly owned. All right, it's a wholly owned subsidiary by another company. Or partly owned by another company. So, I mean, if you are owned, then you cannot go ahead with a consolidated financial. All right, number two is when the parent debt and equity, I mean, their instrument, their capital structure, are not traded in the public market. Okay, so herein, private companies are not forced to prepare consolidated financial statements. All right. Okay, there are others like, I mean, when the parent does not file financial statement to the Security Commission, all right, like SEC, all right, but these are the two main ones. All right, so these are the foundations that you need to know towards consolidation. Towards consolidation. Okay. Now then, let's now come to the basic principles of consolidation. Now, this is what happens. A company will be acquired. So there is acquisition date. And there will be a date where they decide to bring the accounts together. So we call that one the reporting date. Right? And in between this is the interim. At the reporting days, you bought something, all right? So there has to be a determination of gain or loss. On the side of the parent, we call it goodwill determination. And at this date, what will happen is that you need to do a consolidated statement of financial position. In between these two dates, there are so many things that happen here. There are adjustments happening here. And these adjustments may include provision for unrealized profits, intra-group trading, because they will be trading with themselves. A and B will be trading with themselves. And that gives rise to all these things. Then key is that we need to also talk about depreciation and other stuff. All right. So basically, what you're going to do is that you are going to combine two companies. So let's say you have company A and B, and A has gone into, let's say, 51% of B. What is going to happen is that basic rule number one is that you need to combine your assets and liabilities. All right. Assets and liabilities. That's the basic thing that you need to have. But you need to show it, okay? So if A is, say, 500 and B is, say, 200, you need to show it by doing 500 plus 200, so that if there is assets that you are combining, you put yourself down. Please bear in mind that if you don't show this and you just put this there, you are wrong. Please bear in mind, right? Because you have to show the workings. Because I mean, you can simply actually, what is this figure you put? They give you put there. This is what is marked. Show it. 500 plus 200. You need to show it. All right, guys, don't forget this. All right. Now, what is going to happen is that, I mean, this in between transactions that is happening. The second principle is that you have to what, cancel all intra-group transactions. What do I mean? So if A sells to B on credit, then it means that A will be having a receivable, B will be having a payable, and you cannot sell to yourself, right? I mean, how can you do that? You cannot sell to yourself. So it has to cancel off. Your payable, when you are coming together, the payable and the receivable negates themselves. Out. So that is that. That is the key thing. Okay. So that is that. So you cancel off all these balance. All right. So that is that. You now need to go on and determine the cost of the investment in the subsidiary and cancel that one off with the subsidiary's capital and reserve, all right, to leave a goodwill balance, okay? And that is what you see here. So in the books of the subsidiary, you are actually canceling off the subsidiaries share capital and reserves. Okay, and you're actually going to replace them by the computation of your goodwill. All right, so this is what happened. This is what happened, and this is what you need to go through to do. Okay, so that is what. So in effect, what we are saying is that you are going to add the assets and the liability. You add them. You are going to cancel off the capital of the subsidiary. So what is going to actually remain in the capital is the parent's one only. Okay. The retained earnings, what is going to happen is that you are going to also replace the retained earnings of the subsidiary by working some goodwill. Okay, so that is what it's going to happen. If there is post-acquisition retained earnings, then it means that your total retained earnings here will be the parent retained earnings plus the post-acquisition profit made by the subsidiary, all right, when you were part. All right, so that is what you're going to do. So straightforward, this is how the thing looks like. So all you need to do is to go ahead and add. Remember, there's capital that will remain is the parent one. Okay, the retained earnings will be the one that is set between them. So you have the parent one. If there's any post-acquisition profit, the subsidiary which you add, right, all together. So that is how it looks like. So that is the basic principle surrounding this concept of consolidation. All right. That said, I want to straight away go to how you prepare for your exams and your questions, because your exams, what you're going to do is to be preparing a consolidated statement of financial position, consolidated statement of profit or loss, and other comprehensive income. These basic two you are meant to undertake. All right, so that is that. Don't forget there is consolidated statement of changes in equity, consolidated cash flow. These are the two ones. Okay, so let's take them together. Now, I want you to bear in mind that if you are preparing a consolidated statement of financial position, or what we call group financial statement of financial position, and it will be as at the reporting date. What you need to realize is that there will be an introduction of goodwill, and you'll see later that we're going to do a workings called workings number 3. Then you bring in your assets. All right. Don't forget the asset is NCA and CA. All right, you bring them, but when you are bringing them, remember to make it the P plus S, the P's own and the subsidiary's own. Okay. Then you get what the total asset. So don't forget that these things can be split into plenty. So NCAs, you can give you PP and other things. The CAs, inventory, receivables, cash and bank, and all those things. Right. So this is the snapshot of it. Then you come to what? Popular equity and life compact, your special FP. The equity, you will show the parent one only, right? That's true. If there is any other equity component, you are bringing it, and this one will come from a workings that I will later show you that called workings 5. All right. Then you have things like retained earnings, which that one too I'll later show you in the workings for workings 5. Then you have what we call non-controlling interest, which that one too I'll show you later in workings 4. All right, and when you sum them up, you are having your total. You now need to go through and bring in your liabilities. And don't forget, your liabilities can be split into NCL and CL. Once you add them, then your account here balances. Okay, So you have your balance. So it's a short thing you need to go through and do, except that in these cases, each one can be expounded in terms of the asset and the liabilities. Okay, so in a typical question of preparing a statement of financial position for a group or consolidation, there are 5 stages that you need to go through. We are talking about a subsidiary here, all right? Later on, we will look at how the associates look like. As it stands, we are looking at the groups with a subsidiary. What is going to happen is that there are 5 workings I need to show you to go through and perform, all right? So the first working is what I call the group structure. Working 1 is what I call the group structure. All right, the group structure. And here you are going to show us who the parent is. We are going to also show us who the subsidiary is. So you put their names there, all right? And here you need to show us the percentage of ownership. Don't forget, it should be more than 50%. So example, we have like 60%. All right, so that is that. On this side, you need to show us the date, the period acquisition. All right, the day they bought the company. So probably that thing can be, let's say, 01/01 2021. All right, so sometimes it can be 3 years ago, 2 years ago. Or it can be like 6 months. All right, so you need to show us all those things there to the group structure. The most important working in the consolidated account is the workings number 2. And that is the most important working. If you get this side wrong, sorry, your life is going to be very tough. All right, so I'm going to give you all the elements that are possibly likely to happen in your exams. And I tell you, you not see this thing anywhere in it. Right? This thing is tailor-made after going through plenty examination questions. All right, so that is what I need to show you. Okay, so how does it look like? This is how it looks. We call it the fair value of net assets. The net assets of the subsidiary. All right, and we have 3 timings here. We have at acquisition date, at the acquisition date, we have at reporting date, and we have post acquisition. Now, don't forget, a company can be acquired now, but the day that they will decide to consolidate their account is different. It can be within 2 months, they will decide to consolidate it. It can be within, after 3 years, they can decide to consolidate it. It takes time, sometimes 4 or 5 years. Yeah, that's that. Now, so the format theory, so you bring in your currencies, all right? There are zeros you need to put there, just put them. You need to check the question first. I don't mean that always put this. Check the question first if the need is. All right, then like you said, you start with the equity capital of the subsidiary. All right, and here the purpose is to check any movement towards the post-acquisition engagement. You will have your capital and it will never change. I mean, the same way you bought it, yeah, capital is what it is in respect to you, all right, in respect to you. Then you have your reserves. The reserve you have like share premium, and that one too has the habit of restricted capital. You now need to come in and bring in other equity components. You have some, like example, the revaluation surplus. And that one will show you some signs of movement. All right, so the difference between the movement from here to here, it gives you some difference, which is good. All right. And you come to your almighty retained earnings. Of course, there will be a movement, as you see. There are things like fair value adjustments. We will look at all these things one by one. You get it. And you may have to do the adjustment, all right? Then you have to work the depreciation on these fair value adjustments of PPE or the NCA, and you realize that depreciation is charged at the end of it, right? So if here is 0, we moved here, then it means that there are other things like PAPs, which is very, very important. Now, the PAPs, I'm going to split it into two. I have PAPs inventory. Okay, and for the PAPs inventory, it is only when the subsidiary is selling to the parent, okay? Subsidiary sells to parent that we are interested in here. Okay, and that one too, as you see. However, there is another PAP that may arise from PPE transfers. All right, and that one too, the same thing when S transferred to P. So this is what you get. But later on, I'll show you that when P transfers to S is the opposite, all right? And this is just for inventory only. Inventory only. So it gives you a positive. So what I'm going to do is to restate this thing on another page for you. So remember, we are talking about weapons 2, and we said it's the fair value of net assets of the subsidiary. And we have 3 dates. We have at acquisition date, at reporting date, and their movements given in the post acquisition. So we started with equity capital or share capital, and we said that there is no more. Came to our reserves, where we looked at share premium. It takes the character of equity capital. We talked about other equity components. Typical example being our revaluation surplus. And we have some movement on that. We come to our almighty retained earnings, which will always show movement. All right. And I came to what? Fair value adjustment. And I did fair value adjustment depreciation. given that there's and I said things of part. But before I even write the part, let me just remind you that if there is goodwill seated in the subsidiaries account, all right, inherent goodwill, it has to be taken off the books, all right. Because remember, IAS 38 doesn't give inherent. All right, so that is that. We talked about parts, and I said here I've grouped it into two. You will not be seeing this thing in any book. Part inventory is when S, the subsidiary, sells to P. Please take note of that. All right, so that is that. Here, everything here is about the subsidiary, right? The activities of the subsidiary. Note that. All right, then what is going to happen is there another part, and here I call it part PPE transfer, right? That one to the same thing when S sells to P, you have what you see here. But P selling to S to change the disposition. And you see that later on in the course, you see all these things in terms of the entry. All right. So that is that. Don't forget that you can also bring in what we call uniform accounting policy adjustment. Any adjustments that you do, all right, takes this shape. Okay, takes this shape. All right, so that is that. At the end of the day, you are going to total, see, total them, and you're going to use this one for your you're going to use this one to for your workings 4 and 5. That is that. And you are going to use these items also for your SOFP, all right, with the exception of these equities. All right, we're going to use the depreciation, which the double entry will affect the NCA, and inventory, PAP, will affect inventory and all those things. All right, so that is what we have. Let's now go in and look at workings 3, which is very interesting. We are talking about now, assuming you bought 100% of the company, that one becomes so simple. Because what you're going to do is that if you bought 100% of the company, then it means that all you need is your purchase consideration, the money that you pay. You need that, and you have to less what? The net assets, fair value of net assets. Of the SAP. Where are you going to get this one from? Remember, it's coming from that's what at acquisition. You less it, and what you get is what we call goodwill. But let's be realistic. You are not going to be given a question where 100%. You are always going to be given less than 100%, but more than 50%. So what that is going to do to you is that you need to go ahead and bring in the fair value of your purchase consideration. Okay, and since you did not buy all, we need to bring in the NCI, the non-controlling interest. When I say NCI, I mean non-controlling interest at acquisition. And I'm going to talk about this thing very soon. All right, because there are two methods of determining this. We have the proportionate method and the fair value method. All right, so that is why I'm going to give you the scenarios for each method, that if you are going to apply any of the method, it has consequences. So you need to be aware what that one will bring into the picture. All right. Now, when you add this, You have your balance, then you have to come now and less what? Fair value of net assets, right? Fair value of identifiable net assets at acquisition, which is actually your workings to this one, this figure. That is why I'm saying that if you don't get this one correct, I mean, you'll be carrying on the figures that are wrong and it will mess up. So you now less it. All right, then you now get what you call your good. Now, look at this. Look at this very carefully. Depending on how the question quotes this, because we have fair value method of getting this, which will be given to you in the question. If you are going to use the fair value, the figure will be given to you in your footnote. Note that. And we have the proportion. The proportionate, all right, proportionate. Now, if this method is used, what is going to happen is that you are now going to get what we call impairment. Impairment, all right. And that one, like I said, it comes to the fair value method only. Only. So you have to less it. And you get your goodwill carried down, which will go to your SOFP. But if the proportionate method is used, you won't have any impairment. Okay. Proportionate method, what happens is that they will tell you that the NCI is measured at a proportion to this figure. So you will have to say, if they say 20%, then it means that you will compute 20% on the figure that you have and bring it here. Then you later come and less the full amount again, all right, here. Okay, so that is it. Now, what that will bring is that it will make you see the goodwill that you have computed here is actually in proportionate to what you are acquiring, all right? And therefore, you may be given an attributable goodwill for the NCI. So what you will work for is the CI of your purchase, and the goodwill for your purchase, okay? It means that it doesn't have the goodwill of the NCI over there, all right? So in the question where you'll be given an attributable goodwill for the NCI, then it means that after you've done your normal goodwill, you need to add the NCI to it. You will see these things that I'm talking about when you start with the computation. Okay, so what I'm saying is that if the proportionate method is used, the goodwill that you find, okay, is the goodwill for your purchase. It doesn't include the NCI, this part. All right. But if you use the fair value method, I mean, it embodies everything. Okay, it embodies everything. So you are likely to be given an attributable goodwill for the NCI when the proportionate method is used. At that point, when you get here, you need to add the attributable goodwill to it to get your total goodwill. All right. So that is what I mean. That is what I mean. Let's not make this thing look so abstract. Let me try my best and bring in figures in so that you will appreciate some of these. All right, so that is that. We are going to go into the figures soon, but let me say that when you get this goodwill, it can be positive, it can be negative. Positive is usual, it's normal, and so it will go to your SOFP after any impairment calculation. Then the negative here, all right, will go to, if your goodwill were to be negative, then it will go to your workings 5. All right, to go to your workings 5. All right, so note that. Let me. All right, so we've talked about positive goodwill. and it being tested for annual impairment, especially when the fair value method is used. Okay, so that is that. And like I said, goodwill is a gain. Negative goodwill is a gain. Gain on bargain. And that one will go into your workings 5. I'll show it to you once we get there. But watch this. This is what I was talking about. You have 2 methodologies. So what you're going to do is simple. A parent has 75% of equity in a subsidiary for 156. So that is the purchase consideration. That is what they buy. The remaining shares were valued at 52,000, and the net assets at acquisition was what? 170,000. And he said we should calculate goodwill if the proportionate method is used. So what we're going to do here is that remember we need our purchase consideration, which is how much? 156,000. And we didn't buy everything, so we have NCI, and this NCI is what they're telling us to use proportionate. So you see that the part that you didn't buy, you bought 75%, means you didn't buy 25%, and therefore that one would be 25% multiplied by what? Remember, like I said, the fair value of assets at acquisition. They said that the remaining shares were valued at this. So that is where we are looking at as what? The number, the shares, all right, the remaining shares, that the shares that were valued. Okay, so that is the NCI. Here they've given us the value, but here we are taught to use the proportionate, and they told us that the net assets at acquisition were 170, and this is where we are interested in for the proportionate. So what you're going to do, remember, this is your working 2. Don't forget. All right. So what you're going to do is to do 25% of 170. 170. Now, take your calculator and you do 25% of 170. Don't forget the 25% is the part that you don't control. All right. So you do 0.25 plus multiplied by 170,000. And what you're going to get is what? 42,500. Okay. So if you add this here, then it means that you have 42,500 and 156. All right. So what that will going to end you up is 198,500. All right. Then you come and less what? Your workings 2, which is fair value of what? Net assets at acquisition. To see clearly that the fair value of net asset acquisition is the 170. All right. So when you take 170 out, what you're going to get is 28,506, and that is your goodwill. So when the proportionate is used, you are going to compute percentage that you don't control on the fair value of net assets. This one is given to us, but in the normal typical exam question, we will have to work for it. All right. Then they tell us that we should go and use the fair value method, which is simple. You have your purchase consideration, which is 156,000. Your NCI is therefore given as the fair value, which you have here, 52,000. Together, I think you have 208,000. Then you now less the fair value of net assets at acquisition, all right, which is the 170,000. Okay, so you have 208, 170, which will give you what? 38,000. So that is how the 2 method works. One of them, you have to compute the percentage that you don't own on the fair value of net asset, which is at 2. As for the fair value, if this one is given to you at fair value, the question will always give you the fair value. So you don't need to be looking for the figures, looking to compute for figures when you are using the fair value method. It will always be given. So in a question where it is not given, then it means that indirectly you are meant to use the proportionate method. All right. So that is because the percentage you don't own, you will know, and the part here is what you will be working at your. Yeah, it's that simple. It's that simple. Now, that said, let's go on and see how our workings thread looks like. Our workings form, sorry, looks like. So this is how our workings thread looks like. Let's go on with it's 4. Don't forget that we are doing 5, right? We are doing 5 workings. So workings 4. Before then, let me check just for further understanding of what I just did, that if there is any other. All right, it's fine. We can go on. All right. Our workings 4 is for our NCI, the non-controlling. So that one you have to, the non-controlling interest here, we know that if you buy 51%, then it means you don't own 59%. So that is what okay. So we need to compute that part of it, all right? And like I said, remember the proportionate concept and the fair value concept, all right? So you start with your, you have your RNC, the need be to add 3, right? You start with the first thing you need to start with is the NCI value at acquisition. And where will you find that? Don't forget, it's your working standard that we get. All right, whether proportionate or fair value. So you get that one. Then you need to do NCI share, all right, of the post-acquisition movement. Remember, that one is coming from workings 2 in the net asset, all right, where we did fair value of net asset at well, post-acquisition. Now, you are going to share that one, and you know the percentage. If you bought 75%, means you the NCI is 25. So you do 25% on that one, all right? You see, we had at acquisition, at reporting, at post. The total there where I show you that you are going to split into 4 workings, 4 and 5. That is where. So that one is coming from 2. You apply the percentage on that, all right? Then you add. Okay, so that is. And if the proportionate method is used in the exam, like I said, you may have NCI allocated goodwill. Here, it talks about anything NCI, all right? Everywhere you see the NCI, that is going to happen. So if you have any allocated goodwill, which stands by the proportionate method, then you have to bring it here. Then you have to go on and list what the NCI share of goodwill impairment and expense shared amount of goodwill impairment. And that one comes by the fair value method only. So at the end of the day, you get what your NCI to your consolidated, your console SOS. All right, so that is that. This shows the value of the subsidiary that is not owned by the parents at the end of the day. All right, so note that. All right, then we move on to our workings number 5. Workings. When we start computation, we really appreciate what we're doing. So here we call it group reserves. You can also call it group retained earnings under the bigger group reserves. Please spend time and get these workings in your head, because in every exam you need to show us these workings. Okay? You cannot do around it. You need to show us. All right. So here, don't forget you have your parents' retained earnings. We are talking about the 200%. You need to bring it here. And for each of any subsidiary that they have, Just like you did NCI, so you have to do controlling interest share of post-acquisition movement, all right? Or you can call it post-acquisition profit. All right, so that is that. Remember that one too is your what you share here, the balance is also shared. All right, then you have to add any gain. You remember the gain I talked about, negative goodwill. You have negative goodwill. Your goodwill is negative. All right, and this one is coming from where in workings 3. You add so. All right, so that is that. Then you now list those things such as what? CI share of goodwill impairment. Okay, then you also here you list any parts. And the parts we are talking about is inventory. And it's when P sells to S. All right, so P sells to the subsidiary. Okay. If S sells, it goes to workings 2. Don't forget that. Okay. And like I said, there is part on PPE transfer. So that one to when P sells to S, the same thing. But when S sells to P, it changes the dynamics. That is for the PPE side only. Okay, change the dynamics. Yeah. All right, so that is that. And the last thing that you may be bringing here is what we call unwinding finance. Somebody said, does it come here? It comes here too. When it depends on how the purchase was developed. Right? So if there is any of such, okay, then you get your group retained earnings or group reserve, which will also go to your SREM. So ladies and gentlemen, these are the 5 things workings you need to go through. In any question, embodying parent and subsidiary. All right, you need to take your time and go through this. All right, take your time. So what I'm going to do is to bring up a brief question. Then we apply these things. All right, for the meantime, it gets it now moves stronger and stronger. All right, so that is that. Yeah, that is that. All right. So to close today's class, talking about just the introduction and the principles, let's just look at some short examples that we can apply what we've learned today too. All right, so let's look at Matthew. Let's look at Matthew. The question tells us that Matthew acquired 80% of Jones for 600,000 Ghana cedis. Don't forget, 2 years ago. All right, when Jones retained earnings, show the balance of 100. All right, so this one will tell us that our NCI will be what? 20%. This one will tell us that the timing of acquisition is what? 2 years ago. And we have retained earnings at reporting as acquisition date. Now we have the NCAs, the investment in June, and this is what the investment is talking about. All right, so that is that. And sometimes if it doesn't match, whether if it is more than, then it means that Matthew actually has other investments somewhere. All right. Okay, so that is that. So we have the other things we see here, and they said that the non-controlling interest is a fair value. Like I said, if immediately they say fair value, it means that that particular amount of fair value will be given to you in the question. It will be given to you in the question. Like you see here, it is what? 200,000. All right, so that is that, 200,000. So students will always prefer fair value method because the figure will be given. Now, what do you need to do? Remember what is one structure. What will the parents say? Matthew. Okay. Then it's acquiring home Jones. What is the percentage of ownership? Say 80%. Time of acquisition, 2 years. You've done this, you get your take. It's as simple as that. You don't need to go on to your school and say fair value of net assets of subsidiary. You have at acquisition, at reporting, you have post acquisition. All right. We said that it starts with stated capital. What is the stated capital? How much is the stated capital of the subsidiary? We need is 1 CD 100, which means that, and like I said, you can actually put the measures each one. Let's put them here. All right, just as they've done here. Okay, so that is what it's going to have. The subsidiary, yeah, I have 200. Please, it is the subsidiary. Don't go and pick anything parent. Okay. All right. So at reporting to 200, there is no movement. What do we also have? Retained earnings in the capital structure. That is where you look at. At reporting, it is 400,000. At acquisition, it was what? 100. So you can clearly see the movement to be what? There's nothing again under the equity aspect. So you can close this. You have 300. You have here 600. And the movement is 300. Don't forget, you are going to use this thing for workings, okay? And you are going to share this one for workings 4 and 5. All right. So let's look at the goodwill, workings 3 goodwill. Purchase consideration, they told us in the question, they bought it for how much? Fair value is 200,000. They bought this company for 600,000. All right, so yeah. The NCI, the part that we don't control, was given to us at fair value. Don't forget, 200,000. That gives us 800. And we now need to less what? Fair value of net assets at acquisition. And which one is that? This, it is. Okay, so that is that. You need to less that one, 300. So we have what? Our goodwill to be. And this goodwill is the goodwill at acquisition. So if there is any impairment, you impair it, all right? That's to be reviewed annually. All right, so that is that. You go to your workings for, there's no impairment in this person. If they were, we will just do it. Workings for NCI. So what you're going to do is that you need to bring in your NCI at acquisition. Don't forget, we pick this one from to at acquisition, which we are going to pick from where? Workings 3. All right. NCI at acquisition. All right. Okay, what we need to go through and do is to add what? Yes, what? We share. I was waiting. You share. NCI share of post-acquisition profit, which you have here, So if 80% was bought, then it means you need to apply 20%, multiply by what? 300 cities. That is going to give you 60. There is no impairment, so, and there is no allocated goodwill, so we end up with 460. Easy peasy. All right, you now go on and do workings 5. Workings 5. Why do I do this? Let me see if I can have the middle. All right, so you have workings 5, group reserves. Start with the parent, right? 100% of the parent. How much was that? This is it. 800. All right, then you had what? CI share of staff, which is coming from your workings too. All right, don't forget that. This one that we are sharing, profit, which is 80% times 300, which will give us like 240. So you have 1040. There's no goodwill, there's no apps, nothing here. All right, so once you are done, you are going to repeat all these things that you see here again. So you have you will bring in your goodwill, like I showed you, then you add the assets together. You have 1,000, you have 500. The investment is the purchase consideration with you, all right? Then you add these two assets. Equity, we are talking about the parent only, all right? Reserves, that is what we've gotten from workings 5 to replace it. Then this one too will add here. So let's see if our balance sheet will balance. So what we actually saw, if you are preparing our consolidated statement of financial position or group statement of financial, assets, the date as per this question, we don't have any date given us. All right, so what we're going to do is that we bring in our goodwill, and please, you need to show that it's coming from what is correct. All right. Also, our goodwill, we had 500. The NCA, we had to combine and show it. Please, I told you, don't miss this. Show it. You have 1,005. All right, and you have your current assets. Show it. 800 plus 600. It gave us what? 1,004. All right, so together, what we have will be what? 3,400. Stated capital, you state it, and don't forget the parent only. What do you get? It's what? 500 as well. Then retained earnings, we work it out, working 5. We have 1040. All right, then don't forget there is NCI. All right, workings 4. It gives us 240. 260. Sorry, gives us 260. When we add them all up, we are having what? 1,800. Then we have our liability. It's what? 1,001 plus 500. And we had that one to be 1,006. So that one gives us. So easy peasy. That's how you go. Here we balance our. So what is going to happen is that in a typical question, we are going to bring in parts which will affect our inventory. We are going to look at that. Don't forget PPE transfer, revaluation surpluses. I mean, we are going to expand it little by little. All right. So that is that. That is that. So you have this to go through, and you have an assignment to also work for me, which you are going to have in your platform. All right. So go through it, the 5 steps, go through it. We will expand these things by looking at the places that your examiner is likely to trick you. We'll get ready for that. All right. Thank you. God bless you. Have a nice day.